Thank you. I enjoyed the exchange between Mr. Kupnick and our chair. The chair points out that Silicon Valley Bank was terrible management, as if that was a lightning strike. No. We have a system that says you buy long-term bonds. If they go up, you sell them. The bank recognizes an immediate profit, and the board of directors gets a huge bonus. And if they go down, you can hide that loss, and 99 times out of 100, you'll get away with it. And so bad management is from bad rules, and I've been in this committee for a long time saying we have to mark to market long-term debt held by banks. The chair also says that we should allow state regulation to provide for corporations. That is a race to the bottom. And again, we have bad management because of bad incentives. A state legislature in a small state, they're focused on getting revenue for their state, not upon providing good corporate management and oversight for corporations that may have a little impact on their state. So we should not, we need to deal with long-term debt on bank balance sheets. We need the federal law to provide the rules for national corporations. Finally, we have a system which doesn't give investors the information they need. 100 years ago, when our accounting systems were designed, or the financial statements were designed, the vast majority of the value of a company was in its physical assets shown on its balance sheet. Today, the most valuable thing is intangibles, particularly the workforce. Yet, again and again, we don't require the disclosure of turnover rates, training expenditures, or anything else relevant to the workforce. And for several years now, I've been pushing for us to disclose the China risk. Because what's the good of knowing last year's earnings per share if you can't even get management to tell you how they'd be affected by a breakdown in the U.S.-China relationship? Today, we're focused on Dodd-Frank, and it brings the PSTD of the 2008 crisis, when this committee said, never again. History doesn't repeat itself, but it rhymes. We have an echo of 2008 in Crypto Week. Now, this is also Tax Evaders Month and Drug Dealer Facilitation's year. Both bills rejected an amendment that I proposed here and to Rules Committee saying no bailouts for anyone in the crypto ecosystem. Those amendments were rejected, and the crypto world is looking forward to telling its investors they're as bailout eligible as Bank of America. But what caused the 2008 collapse? It was the subprime and liar's loans. What's a liar's loan? You agree to pay 1% more on your mortgage, and the lender says, well, just tell us what your income is, and you don't have to give us a W-2, you don't have to give us a tax return. So the financial system back in 2008 strained to provide financial services to those who turned to their mortgage broker and said, I really make a lot, I'm just lying to the IRS or my ex-spouse. Well, history rhymes. Today, this week, we're going to deal with stablecoin. What is stablecoin? It's a money market fund that pays zero interest. A worse deal for consumers, just like the liar's loan is, where you pay more on your mortgage. But what does the stablecoin offer? It offers hidden money so that you can defraud the IRS, your ex-spouse, engage in drug trafficking, etc. So history does not repeat itself. It rhymes, and here we are back again, trying to have our financial system meet the needs of those who want to cheat on their taxes, engage in illegal activity, etc. Mr. Benson, your letter to the SEC talks about the separation of functions with vertical integration, where a single platform can act simultaneously as the issuer, broker, and exchange and custodian. Can you explain what the risks are of allowing that integrated structure in the crypto world?
Gentleman's time has expired.